Good morning. Good morning. It's Jeffrey Cohen, Chicago Quantum. How are you? We got an action-packed Week 37 review. Lots to cover. I've got the stuff on the side. So the stock market was quite active last week because we had quad witching hour, and so we are going to talk a little bit about our decision points that we have. There's been a lot going on. We're going to share. Some people ask, Jeff, why are you sharing so much? Well, I think running a startup, it's helpful to have people to kind of know where you are and feel the support of the community. And that's what we are right now. There's a lot going on. And so just to start it off, this is the view of where the stock market is this week. So if you look back over last week, it's pretty mixed. Energy's up. Lots of basic economy things. Industrials are down. There's mix around the consumer. Communication services are continuing to be down or flat. Banks are, kind of mixed. So last week was kind of a mixed week. It was almost feels to us like a bit of a plateau. And so a couple things, right? Today, market was supposed to be pretty tough. And so we're looking, it's all red. Dow's down 500 points. The Nasdaq's down 260 points. S&P's down 68 points. But what really that says is the S&P is down, 1.5%. Nasdaq 1.75%. Dow down 1.5%. That's a lot. Those are pretty big drops. And so why is it? So we were looking, and there was some news today. So big news is China. Right, you have a company, Evergrande, that may not be able to pay its debt. And so the stock hit an 11-year low, or 11-month low, and, people are worried, right? China's property is worth less. But we've been kind of at a top in the market. And so where are we, right? Do you sell? Do you lock in your gains? Or do you ride it out? Do you buy the dip, just like every other dip that we've had? I don't think people know, but I think Monday, it's in September, there's a little bit of concern out there in the market. And so if we take a look at just today, this is just the look at this morning, you can see every sector is down in the market. Financial is blood red. Tesla's blood red. Energy's blood red. The only one that's got a little bit of a mix is healthcare. I saw something about Pfizer with the COVID vaccine. There was a little bit of news, but in general, it's pretty much down across the board. This is a tough day in the market, right? So one of the things I wanted to share was what happened with quad witching hour. So I'm gonna make a thing here. I'm going to show you a stock that was affected by quad witching. So this is Corbis. We love Corbis. We're in, Corbis actually stabilized. It was up at about $1.25. It looked like it might be kind of rising out of its doldrums. So we bought call options that expired on September 17, $1.50. We didn't buy that many. There aren't that many out there, right? Each call option is worth 100 shares of stock. Seemed like a pretty cheap way to bet on the fact that it was going to go back up to $2. Well, in fact, you see this red bar right here. It really dropped. And so I'm going to take you to another way to look at this. I'm going to go to Market Watch just to take a look at both the volume and the stock trade for the 5 days. So what you see here is from 3 to 4 o'clock, the stock dropped to $1. Earlier in the day, it was $1.14. We were feeling good about it. Stock went up. Plunges almost 15 cents. Almost 14%. If you look at the volume, that is tremendous volume for that stock. And so I think what happened was people had call options or put options and they didn't want to suffer. And so they went ahead and they drove the price of the stock down. And this really happened from 3 o'clock to 4 o'clock Eastern time. So when they talk about quad witching and they talk about individual investors holding a stock, what they're really talking about is you can have investors go out there, or traders go out there and put 500,000 shares at $1 a piece, basically short the heck out of the stock, and then do another 400,000 shares into 20-minute intervals. You're betting $1 million, but you might have $10 million riding on those options, and it only matters for like a couple hours because it expires at 4 o'clock, everything settles, and then we're off to the next day. And now you see it's back up to $1.04.5, and who knows what's going to happen, but it's just an hour. But quad witching, you have to be very careful. So quad witching is when 4 different sets of options or futures expire at the same time. And so there's a lot of money riding on what happens at that moment at 4 o'clock. And so I had read that this was something to worry about. Here it is right here. Now, of course, we hold the stock. We didn't sell it at 3 o'clock, but take a look at that. That's a dramatic collapse in the stock price. If we go back over the month, you see it's at a low for the month. Take a look for it's at a low for 3 months. It's at a low for 6 months. And my guess is it's at a low for a year. It didn't touch that low since basically late October of last year. And so here's a stock that was driven down to its annual lows, probably just to make sure that somebody didn't have to pay on the options that they sold. And so just think about it. Now, why would Corbis be so risky this way? Well, the market cap of the whole thing is 127 million. When we started buying the stock, it was like 400 million. So you're able to drive the market cap down to like 100 million or 125 million, and you can now influence that stock price. And if you're a big money player, you can do very well. And so I warn the folks out there who are individual investors who are not market makers with $100 million and driving individual stocks down, to be wary on that particular hour, or just take a blind eye, don't look. You'll be fine the next week. It's probably going to go back up, right? And so it is what it is. But if you are focused on the hour to hour, then watch out for quad witching. Now I understand. We're going to go through some more things. And quad witching hit a lot of things, and probably is one of the reasons why we're seeing some overhang now, Monday morning. So what did we do as a firm? So we did something kind of special. We submitted our IARD filings. So we are now registering to be a registered investment advisor. We've submitted our filings at the federal level with FINRA. IARD is the database. We're in. And in fact, I've already heard back from the state regulator on exactly what we need to do to wrap up. So what this means is, as a registered investment advisory firm, we're kind of at the level of any of the firms that you see advertising during the football games, sending you an invitation for a free Ruth's Chris steak dinner. Hey, come on in and we'll do financial planning for you. So we want to be at that level because we want to be providing our type of advice to clients for a fee, and we want to be on the up and up. We want to be fully registered, following all the rules. So that's great news for us, and we have so much more to do at the state level. But what that meant is we've discontinued a number of our social media channels. So you might say, hey, Jeff, why is that? We love your social media. Well, the truth is not that many people loved our social media. Maybe I got a couple of likes a day. I mean, it wasn't that big of a deal. No one really bought anything because of it. And now there'd be a regulatory overhang because we would have to keep those postings for 3 to 5 years. So to be honest with you, I got a pretty cheap printer over here. And to print off all these things is crazy, and to keep like software copies, whatever. So we've discontinued media channels. Facebook, LinkedIn, StockTwits, Reddit. And the only one we really have left now is Twitter. And so I'm willing to stick with Twitter. We will have to keep copies, and that's fine. And so, and we did announce that we're going to be having a subscription service. So at some point, we might even discontinue Twitter. And then for a nominal fee per month, you can still hear from us and ask questions and have phone calls and stuff. But, yep. So, and I just talked about it. We have a lot of regulatory filings now that we have to make with the state of Illinois. Thank you to the Securities Department of Illinois for being so on the ball. And we believe we have all these things. We just have to go ahead and pull them together. We talked about quad witching becoming a reality for us. Wow, did we lose money on Friday? Oh my God. It hurts when you think about how much money. If you're in biotech and you're in small caps, and let's be honest, earlier in the week, this was a screenshot we took. The whole healthcare thing was bleeding. Every drug manufacturer, this was on September 8th, every drug manufacturer was down for the most part. Biotech was down for the most part. And so why would we think during quad witching it would go up? And so in fact, drugs are down, pharma's down, small cap is down, the S&P is down. It's just a bloodbath. It's a bloodbath. And so if you're in risky stocks and you don't have an equivalent short position and you're just riding out the longs and you're like, let's go, let's buy the dip. Well, there's plenty of dip here to buy. And you might be buying the dip for a very long time before these go back up again. So, just tough. We're not making any changes, but just know that you have to have a pretty strong stomach. We've been doing a lot of crunches and a lot of leg lifts so that our stomach is strong to handle some of these losses and some of the pain. So, markets open lower today. Today's Monday, by the way, September 20. Markets open lower. Why? Right? So we've been making videos now for months, every week this year. And we called a top with the S&P 500. We called it at 44.32. And we've talked at length about why the market's going to fall. But we don't want it to fall. We lose money when it falls. Everyone does. Come on, your 401k, your investment in funds. I mean, no one wants the market to fall. So why is it falling? Why don't we all just lift the market up? Hey, everyone buy a share. Your favorite stock, it goes up. Well, it doesn't really work that way. So let's talk about it. There are more IPOs. So, of course, somebody came right out there on Twitter and said, hey, Jeff, we've been short IPOs. This is just catch-up mode, man. Woo! IPO time. Let's go. But here's the thing. There's like 100 more listed stocks than there was like a month or two ago. And there's probably 200 more stocks than there was a year ago that are just listed that are like high-end to put your money in. And so that's like 5% of all the issues out there are new in the past 2 months. So that means if you had $100 to invest and you wanted to spread it evenly, everyone gets 5% less. So the prices fall. It doesn't really work that way, but just know that there are machines out there printing out new stocks for you to buy. Well, that lowers the price. It's kind of like the argument for, when there's more stuff to buy, prices fall. It doesn't take into account that maybe more people jump into the market. And so the second thing is, and we've talked about this at length, in fact, we made a page on our website about this. The Federal Reserve Board is going to taper. What does that mean? They're holding like $8 trillion or more of assets on the balance sheet. What does that mean? Okay, Federal Reserve Bank, Federal Reserve Board, the Federal Reserve banking system is responsible for managing the monetary policy and the amount of money we have in circulation. So the way they do that is with open market transactions such as, hey, I'm going to go buy a bond and I'm going to give you money. Buy a bond, give you money. Give you money, give you money. Well, that's like dropping money out of a helicopter. We saw that with the with all the money that the federal government gave everyone. They gave $250 a month now if you have children, per child, by the way, that's under 18. You got additional welfare, additional unemployment benefits, just mailing people a check, okay? But the banks are doing that too. And so they're like, look, just grab all the bonds you can find. We don't really care about the price. We're just going to buy them and give you money. So there are no hyperbole here, trillions of dollars of extra cash. Well, now they're talking about tapering. So what that would mean is instead of buying $120 billion of cash or buying $120 billion of bonds every month, maybe I'll buy 60. Maybe I'll buy 40. Maybe I'll buy none. Maybe I'll sell some and I'll take cash. Well, when you're used to $120 billion a month just being pumped out into the system, and now all of a sudden maybe I'm going to take away $120 billion a month, that changes everything from a banking and a reserves perspective. Same thing for people. If the federal government were to drive rising interest rates, working in concert with the largest banks, because they can do things to the banks, like they can raise reserve requirements, or they could raise the interest rate, what they call the discount rate, the window rate, which is not used, but it's how the federal government tells the banks, hey guys, it's time to raise your rates. Well, now let's say as individuals, we feel a little more pain. Our mortgages go up, adjustable rate, our credit card debt goes up, our car debt goes up, our overall unsecured debt goes up. Now all of a sudden, you're pulling maybe $1 billion or $10 billion or $100 billion out of consumers' pockets. Well, I love showing you my wallet. My wallet's not that fat, but if you were to say to me, Jeff, I'm going to pull an extra 20 out of your wallet every day, at some point, wallet's empty. I'm not going to buy gas. I'm not going to buy groceries. I'm not going to buy furniture. I'm stopping. Because the 20s are going to somebody else, and I don't have them anymore. So that's what taper is. Okay, that was a really long conversation for taper. Maybe I better speed up a little. But now you understand what taper means, right? What's a debt ceiling? Oh, you're going to love this. So it's a cap. Can't borrow anymore. The federal government, right? The feds, the Congress doesn't worry about how much they're borrowing. And by the way, this is not a partisan thing. Trump borrowed so much money for the Federal Reserve. Trump with the Republican Congress. And now the Democrats and President Biden want to borrow. There's a cap now. So guess what? You and I, we know what it's like to have a cap because our credit cards have a limit. I don't have a credit card in my wallet, but here's a credit card. Oh, look, Jeff's got a credit card right here. I use my Girl Scout mask. That's a credit card. It's got a limit. You can't borrow anymore. You can't call up the credit card company and say, oh, you know what? I'm having a hard week. Can you let me borrow some more? So the federal government has that same cap. And so now they want to spend $3.5 trillion on an infrastructure boondoggle. To me, to others, it's a great investment in our future. Well, if the federal government actually has that debt ceiling, so there's things that they can do to solve the problem. And there's a certain amount of machinations, right? At some point, you actually have to stop spending as a federal government, which means firing people, shutting down programs, shutting down jobs, shutting down transfer payments, stopping. If the federal government does that, it could be politically insensitive. People might not get reelected. So they don't want to do that. And so the other option is just don't pay our bills. And so what I'm reading is there's people saying that maybe the U.S. federal government just will default. Well, if that happens, there's a fire sale. Okay? The fact that I'm hearing about it, that I'm reading about it, that the Treasury Department head, Janet Yellen, the chairman of the Treasury, wrote a letter to Congress saying, we might default if you don't take care of this. So stupid. So stupid. Next, U.S. federal policy is turning anti-business. So we've been seeing this for months now. Number one, let's raise the tax rates to 28% from 20% on corporations. Oh, that's terrific. Now every stock goes down because now that discounted cash flow that we talk about, it's less. Oh, let's have more merger and acquisition conflicts. Let's regulate. I posted last week, they're going to regulate beef production. They're going to have more cow slaughterhouses based on the federal government mandating more cows get killed. Well, you know what? That's none of their business. Stay out of the cow business, right? That's what dairy farmers do. And that's what beef manufacturers do, right? That's not your job. There's all kinds of stuff that the federal government's talking about. Oh, they're going to go after ice cream shops. They're going to go after ice cream shops. They're going to go after all the stuff I'm hearing about. They're going after the grocery stores, the drugstores. They're going after the little old lady crossing the street is not going to be allowed to cross the street anymore. Anti-business, right? Well, that's not helpful. What else do we see? Labor shortage. There's a massive labor shortage. People are afraid to go back to work because of COVID. By the way, I don't disagree, right? But just people have exited the workforce. They're done. Goodbye. So I get so many job postings now. But if you're a company and you want to grow, it's really hard to grow. It's really hard to find quality talent. We're starting to look like Brazil here in the U.S. Troubles from China. Well, first off, we're not talking military troubles from China. It's fine. We're talking business troubles. There's a posting here. Let's see if I can find it. It's awful. I got to show you what I found. Where's all my screenshots? Oh, it's in. I'm sorry. Let me grab it for you. You're going to love this. What's going on in China right now? It's not helpful. Evergrande shares dive to an 11-year low as default risk grows. So Evergrande is like a REIT. They invest in property. Well, default risk. So I read about this on Friday. There's a default risk in China for debt. By the way, there's been a default risk in China for debt for 2 years. See, in China, there's not as much cash floating around in the system. They don't have like the Federal Reserve Bank like we do. They don't have a reserve currency like we do. They don't have trillions of dollars in reserves like we do. So what happens is when the banks start to suffer, the government has to step in and help. The system doesn't do it. The government has to do it. And then there's choices being made, political choices. So Evergrande, maybe the government says, you know what, there's too much wealth. We want to equalize the wealth. We want to rejuvenate the Chinese system. So we're gonna equalize the wealth. So there's a couple ways to do it. You could raise tax rates. You could have mandatory, voluntary transfer payments. Or you could just let some of the high-flying companies go bankrupt and you can just destroy the money that the wealthy have and make everyone a little poorer. We don't know what China's going to do. It's a dictatorship, and it is not a capitalist system in the same way that we are. It's a dictatorship. It is a communist system. And so it doesn't surprise me that they might drive, let's say, a couple of companies and then not save them. They go bankrupt. The fastest way to make rich people poor is to destroy the assets that they have. You could start a fire, burn a house down, or you could start a fire and let the companies go bankrupt. So I don't know what they're going to do, but wow, is that interesting, right? I know that my point of view is radical, and it may be wrong, but it is our point of view and no one's paying us to have it. So, future slide. Europe tumbles as Evergrande contagion shockwave goes global. So, what's going to happen if Chinese equities fall? Let's take a look. If I look at the world index and I look at China just for the day, China is blood red. Oh my God, look at that day. Look at that day. China's awful. Right? Where is it? I'm sorry. I'm feeling very crazy, very excited this morning. Look at this. Blood red. I'm going to take a snapshot of that baby because that's really red. That's awful. Goof that one up. I'm not sure what I'm doing there. Apologize. So, China's in trouble. That's really all I got to say to you. And what are we going to do about it? Anything? Nothing. There's nothing you can do about it, right? So, again, fastest way to drive equality is to make everyone poor. Alibaba's down 4.5%. What's going on? It's a great company. Why would you do that? And so, I'm still trying to figure out where we're at with this, right? I don't know. I'm feeling a lot of things going on here. By the way, why is this? I'm not sure why it looks like that. So we're just going to keep rolling though. Let's go back to my list. What else do we have here? Oh, supply chain problems. This was a photograph posted this past week. This is LA. It's beautiful in LA, by the way. Looks nice, sunny and bright. But there's a lot of ships out there. So there's so many ships waiting to drop off their cargo that they filled up all the berths and now they're filling up all the water. So all the places where you're allowed to sit, LA, Long Beach, filled up. So what does that mean? It means that if people want to buy stuff, they're just not available. Your plastic flowers, your electronics, your chips, anything driven with chips, but anything that China or Japan provides us or India provides us or whatever, Middle East, oil and gas, food. So if we're selling food to other countries, you can't really export as much because the ships are too expensive. So we think a lot about imports, but exports as well. The global economy relies on a smooth supply chain. In fact, Dollar Tree not long ago said that the Suez Canal issue, where the ship ran aground, still affecting their supply chain. So, not helpful. Okay. We talked about IPOs. The wildest year for IPOs is not even close to being done. This year, we've had 280 companies complete IPOs. Last year, that figure was just 218. Year before, it was even less. So we're doing catch-up mode on the IPOs. Interest rates are low, but fear of them rising due to inflation concerns is affecting us. So the market will suffer if interest rates rise. Bonds fall, stocks fall. Next thing I'm going to talk about, we do have a big problem here with our market data provider. Market data services provider is having an error. And as a result, our code is not working and we are not able to sell market analyses to our paying clients this past weekend. So we are working on this. It is our number one priority. If you've got ideas, give us a call. it's a big deal for us, and we're pulling out all the stops. So when market data service providers are not reliable, it means that the analysis of the stock market just can't really work. So working on that. We talked about how small caps and high beta stocks look to be in trouble today. Let's take a look. IWM is the Russell. By the way, still in the trading range. It's fine. It's down 2%, but it's still in the trading range. And that's IWM. That's the Russell. Let's take a look at biocaps, biotechs. Biotechs down 1.66%, but as you can see, still in the trading range. So all is not lost here. We're just still in the trading range. My guess is if we look at the S&P 500, I'll look at the SPDR, which is an ETF. We've actually fallen out of the range. This is where it gets interesting now. Down 1.5%, it's fine. But when you start to track the lows and the highs, you create a smooth upward channel. Money-making machine here. And what you see is we've dropped below the channel. And so it could just pop right back up. Hey, look, buy the dip. It works all the time. Or maybe this time it doesn't work. But the dip's a little lower than it's been if you look at the upward trend. What else do we have here in our list of things to talk about? So we learned something about our website. This is kind of cool. You know, if we publish content that people want to read, real content that they can't get anywhere else, and we surround that content with language that is helpful for individuals, and then we advertise it gently, meaning $5 a day, $10 a day for a website, for a page, web page. You'll drive traffic. For the first time ever in our history, we have over 1,000 unique visitors in 1 week to our website. This is great. Love it. Now, since our market data service provider is broken and we're having issues, we've stopped our advertising because I don't want to pay to have people check out the website and then not be able to buy the service. So we're gonna bring it back. But it's really nice to be able to see that. YOLO. So when you guys read YOLO, right, what that means is it's a one-sided bet. It's like buying a lottery ticket. You can buy a lottery ticket. Lottery ticket costs $2. You figure it's not a big deal. Now, if you're only buying it for $2, it's probably not a big deal because the fantasy of winning big is worth $2. The conversation I might have with my wife, my kids, my friends, and say, oh, you know, if I were to win big, $400 million, I'd probably fix the bumper on my car. I'd probably fix my patio. You know, if I had $400 million, I'd probably, you know, do all kinds of great things. I could fantasize about what life would be like. But if you start betting your house payment, your food money on one-sided bets, it's like going to the casino and betting on black or red. I'm betting on up or down at the roulette table. Now, you know at the roulette table there's green as well. So it's usually, if there's 36 spots, 4 green, 32. So I'm 4 to 36, or 1/9 goes to the house. The rest of it's split. So in most cases, your YOLO bets are not 45 to 50%. Maybe like a casino would be much lower. And that's because the stocks that you want to bet on, YOLO, we're going to go up, probably are volatile. Probably other people know about them and they've raised the price of the options. So it's not a good bet. Don't do it. Last but not least, we finished. We passed our Series 65 exam. We filed all the required filings for FINRA. And we are now starting our Illinois filings. We are not yet a registered investment advisor, but we are well on the way. And that is very exciting for us. Finally, full disclosure, we still maintain our full positions in Satsuma, Akebia, and Corbis. They continue to frustrate us. They are falling. We are losing money. It hurts. Just want you to know that. Our Corbis calls expired worthless. As the stock, during the quad witching moment, that 1 hour, dropped from almost $1.15 to $1.01. Hundreds of thousands of shares traded to make that happen. It was like watching a slaughter. Someone slaughtered our stock, and it hurt my feelings, actually. Felt bad. Point is, nothing happened fundamentally. It was just day trading and swing trading and people with much bigger pockets than we've got who moved the stock price of all three of those stocks during quad witching. And that's that. So when you're in the market and you're in really big stocks like the S&P 500 index, yeah, there might be some manipulation, but it's tiny. I mean, this is such a big index, right? But when you're in a small cap stock that's worth $150, $300 million, $1 million moves it. And so you're just not sure which way it's going to move it. You hope it's going up, but it might just as easily be going down. And so if you want to collaborate on our Chicago Quantum Net Score, on data, on running the model, on even working for us, give me a call. There's my number. I actually answer the phone. Not during a video like you heard, but other times. Nothing in this video is investment advice, and you should always do your due diligence before you invest in securities. There is a significant risk of loss when you invest in stocks or bonds or any kind of securities, and there are no guarantees. There's no performance guarantees. And so you could lose everything. You can make a lot of money, but you can lose it. And then I wish you good luck in the markets. I want you to make money, no matter which way you're betting. Be successful. Take care now. This is Jeffrey Cohen, Chicago Quantum. Thanks for listening. Appreciate it. Bye-bye now.